Hello everyone and welcome back to Investment Research. I hope you're doing fine. So today I'll break down my analysis for 5 stocks that I believe present compelling opportunities to buy in November 2025. But before we start, I invite you to join my small community here if you want. It's just optional. Anyways, so I'm not looking at high-priced momentum stocks that have already run up significantly. Instead, I'm focused on quality companies with strong fundamentals that are either reasonably valued or trading at attractive entry points. These are names that institutional investors look at when building long-term portfolios, and I think retail investors should be paying attention. So, first thing first, let me give you context about the market. We're in November 2025, and the S&P 500 is up around 15% year to date. Technology has been particularly strong, driven by AI infrastructure and cloud computing demand. However, not all quality names have participated equally, which creates interesting opportunities. We're seeing rotation where investors are looking beyond mega cap tech and finding value in companies with strong execution and reasonable valuations. That's the theme I'm following with these 5 picks. First up is PayPal Holdings. I know PayPal has been controversial, down more than 75% from 2021 highs with negative sentiment. But here's why I think it's one of the most compelling risk-reward opportunities in fintech. The stock is trading around $73, and this business generates over $6 billion in annual free cash flow. The company overhauled its management team in late 2023, and they're focused on profitable user acquisition and improving monetization. They have 438 million active users across PayPal and Venmo, processing about 1.8 trillion in annualized payment volume. That scale creates massive network effects. The new leadership rolled out an industry-leading cashback debit card and is launching an advertising platform to monetize checkout flow. From a valuation perspective, the stock trades at 2.2 times sales and less than 14 times forward earnings. For a company with PayPal's scale and cash generation, this is remarkably cheap. The consensus price target is around $84, implying roughly 15% upside, but I think that's conservative. Some forecasts suggest shares could reach $81.15 by year end, representing 17.83% upside based on $4.93 EPS and a 16 PE ratio. The risk is that competition is intensifying from Apple Pay, Google Pay, and other fintechs. However, PayPal's advantage is ecosystem breadth and owning both sides of transactions. Management is aggressively buying back stock, signaling confidence. My view is this is a show-me story where the market wants consistent execution before re-rating the multiple. For patient investors, the risk-reward is very favorable. I'm looking for entry in the $70 to $75 range, and I think this could double over 2 to 3 years. Second is Taiwan Semiconductor Manufacturing Company, or TSMC. The stock is up 49.6% year to date, trading around $305. Why recommend it after this run? Because fundamentals continue strengthening and TSMC is a critical enabler of the AI revolution. TSMC is the world's leading semiconductor foundry, manufacturing chips for Nvidia, AMD, Apple, and virtually every major tech company. They're expecting mid-30% revenue growth in 2025, up from earlier estimates of 30%, driven by insatiable AI chip demand. An estimated $5.2 trillion will be spent on AI data centers through 2030, with $3 trillion going towards semiconductors. TSMC, with dominant advanced node manufacturing, is positioned to capture significant spending. What makes TSMC special is their technological moat. They're the only company manufacturing chips at the most advanced nodes at scale. Competitors like Intel and Samsung are years behind in process technology, giving TSMC pricing power. In Q3 2025, revenue was trending up 33 to 35%, with EPS up 13 to 14% year over year. The street is bullish with a strong buy consensus based on 8 buy ratings, 1 hold, and 0 sells. The average price target is $340.75, representing 11.69% upside. Susquehanna raised their target to $400 from $300, and Barclays raised to $355 from $330. Regarding valuation, TSMC trades at 25 times forward earnings. in absolute terms, it's not cheap. However, for a company growing revenue at 35% annually with expanding margins and a near monopoly on advanced chips, the valuation is reasonable. You're paying 25 times earnings for 30-40% annual earnings growth potential. The key risk is geopolitical, as the company is in Taiwan. However, TSMC is building facilities in Arizona to diversify, and their strategic importance to global tech infrastructure provides insulation. My view is this geopolitical risk is overblown and keeps valuation reasonable despite dominance. Any pullback toward $280, $290 would be excellent entry. At $305, it's still a buy for long-term investors, but scale in rather than deploying all capital at once. This is a position to hold 3 to 5 years. Third is Airbnb. Shares have declined about 9.53% year to date, underperforming the S&P 500's 16.52% gain. The stock trades around 121, 125 don, significantly off highs. However, the underlying business is executing well, but being penalized for what I believe are temporary concerns. Airbnb operates over 8 million active accommodation listings from 5 million hosts across almost every country. This is a massive network effect business where each new host makes the platform more valuable for guests and vice versa. The company takes transaction fees for bookings, making this capital light with high margins that scale beautifully. Q2 2025 revenue grew 13% year over year to $3.1 billion with a healthy 34% EBITDA margin. Key highlights include an impressive 83.2% gross margin and $4.3 billion in trailing 12-month free cash flow. So we have 80% plus gross margins generating over $4 billion in free cash flow trading at roughly $75 billion market cap. That's about 18 times free cash flow, which isn't expensive for this quality and growth profile. The stock has been weak due to concerns about slower nights, booked growth, and increased competition from hotels. These are legitimate concerns, but I think the market is overweighting them. The travel industry has fully recovered, and Airbnb's model works in both up and down cycles. Wall Street consensus is hold based on 11 buy ratings, 15 holds, and 5 sells. The average price target is $139.21, representing 10.56% upside. The range is wide, with the highest target at 180 and lowest at 104, suggesting the market hasn't reached consensus. The company maintains a trailing PE of 29.09, which is a premium to traditional travel, but a discount to many high-growth tech companies. Given Airbnb is essentially a technology platform with travel exposure, this valuation is fair to cheap. They have a strong balance sheet with more cash than debt. My thesis is straightforward. Travel demand remains strong globally, and recent weakness created an attractive entry point. The market underestimates the durability of their network effects and brand strength. I think a reasonable 12-month target is 150-160, representing 25 to 30% upside. Fourth is Mercado Libre, the e-commerce and fintech giant in Latin America. The stock trades around $2,340, and yes, that's a high absolute price, but what matters is valuation relative to growth and business quality. Mercado Libre is often called the Amazon of Latin America, but that doesn't do it justice. It's Amazon, PayPal, Block, and Shopify rolled into one, and it's in a much earlier growth stage. They operate in 18 Latin American countries with an integrated ecosystem, including e-commerce through Mercado Libre Marketplace, fintech through Mercado Pago, logistics through Mercado Envios, and credit through Mercado Crédito. This integration creates competitive advantages difficult to replicate. The financial performance has been exceptional. The marketplace saw $15.3 billion in merchandise volume in Q2 2025, up 21% year over year. Mercado Pago processes almost $260 billion in annualized payment volume, with 3/4 coming from outside their e-commerce platform, showing it's become a financial services platform in its own right. Mercado Crédito has $9.3 billion in outstanding loans and is growing rapidly while remaining highly profitable. What excites me is the long-term opportunity. Latin America is early in e-commerce penetration compared to developed markets, meaning a long growth runway. Financial inclusion is a major theme, with millions gaining banking access through Mercado Pago. Recent earnings showed revenue increased 43.56% year over year, net income increased 93.62%, and EPS increased 94.8%. These are growth rates you simply don't see in large caps often. The company isn't just growing the top line, they're dramatically improving profitability as the business scales. This operating leverage makes Mercado Libre attractive. The street is very bullish, with 18 analysts giving a strong buy consensus and an average price target of $2,796, forecasting 17.64% upside. The lowest target is $2,200 and highest is $3,500. Regarding valuation, trading at roughly $2,340 with $118 billion market cap, Mercado Libre isn't cheap on traditional metrics. However, when growing revenue at 40+% and net income at nearly 100% year over year, traditional metrics become less relevant. The question is whether they can sustain high growth as they scale, and based on Latin America's market opportunity, I believe they can. Risks include currency volatility in Latin American markets, potential economic slowdowns, and competitive threats. However, Mercado Libre has navigated these challenges over the years. My view is this is a core long-term holding for exposure to Latin America's digital economy growth. The company has multiple growth drivers, strong competitive position, and consistent management execution. Quality businesses like this rarely go on sale, so scale into the position over time. Finally, Advanced Micro Devices, or AMD. AMD has more than doubled year to date, partly due to their blockbuster OpenAI deal. The stock trades around $264, near all-time highs. Why buy after such a move? Because the fundamental story is even stronger than stock performance suggests, and they're positioned as a major AI infrastructure build-out beneficiary. AMD supplies chips for popular consumer products but is fighting to catch up to NVIDIA in data center GPUs, which are primary chips for AI development. Oracle plans to deploy 50,000 of AMD's next-generation MI450 chips before year-end. IBM announced plans to use AMD chips to process algorithms for quantum computer error correction. These are significant design wins showing AMD is becoming a credible NVIDIA alternative. The headline news was the OpenAI partnership. OpenAI signed a deal to deploy 6 gigawatts of AMD data center chips by 2030, estimated at around $90 billion. AMD's entire data center business generated about $13 billion in revenue over the past 12 months. This single deal could add $15 to $20 billion per year at peak, which is transformational. As part of the deal, OpenAI gets rights to buy up to 160 million AMD shares for 1 cent per share by 2030 if milestones are met. This is essentially a massive warrant grant that could be dilutive, but AMD structured it this way because OpenAI doesn't have $90 billion cash now. Beyond OpenAI, AMD's core business remains strong. Data center revenue reached $3.2 billion last quarter, up 14% year over year. They posted record EPYC CPU sales thanks to cloud computing and enterprise demand. Analysts expect earnings per share to grow at an annualized rate of 39% over the next several years, with Wall Street expecting almost 35% annual growth over 3 to 5 years. Based on trailing 12-month adjusted earnings of $3.45 per share, the stock trades at a PE of 73.3. That's expensive in absolute terms and more than Nvidia's P/E of 52.3. AMD trades at a premium to the market leader despite being the challenger because the market is pricing in continued share gains and the OpenAI deal materially changing trajectory. Looking forward, AMD trades at approximately 64 times 2025 earnings estimates. If they can grow earnings at 35 to 40% annually, you're paying less than 2 times the growth rate, which is within fair value range for high quality growth. The 33 analysts covering AMD have a buy consensus with an average price target of $216.30, actually below current price, showing the stock ran ahead of expectations. However, the range is wide, with lowest target at $120 and highest at $310. My view on AMD is nuanced. The long-term opportunity is massive, and they're well positioned for AI infrastructure spending. However, the stock moved quickly and consolidation would be healthy. For investors without AMD, I would not chase at current levels. Wait for a pullback to 220 to 240 for better risk reward. For existing shareholders, holding makes sense, though taking some profits on strength would be prudent. The next catalyst is Q3 earnings on November 4th, which could provide the next leg up or a buying opportunity on weakness. So there you have it, my 5 stocks to buy in November 2025. PayPal is a turnaround story with new management executing well, trading at very attractive valuation. TSMC is the essential AI enabler with a technological moat that's difficult to replicate. Airbnb is a high-quality network effects business unfairly punished. Mercado Libre is capturing the Latin America digital economy transformation, and AMD is positioned to take meaningful AI chip market share despite near-term valuation concerns. These are quality businesses with strong fundamentals at reasonable prices, exactly what you want to own for the long term. As always, do your own research, understand your risk tolerance, and never invest more than you can afford to lose. Thanks for watching, and I'll see you in the next analysis.